Hi, everyone. Thank you so much for taking the time to join today's session. A few housekeeping items. You will be automatically muted throughout the presentation. If you have any questions, please click on the toolbar to the right-hand side of your screen. You can send in questions throughout the presentation, but our speaker will be answering them at the end. You can also find today's slides under the Handouts toolbar, again, on your right-hand screen. And at the conclusion of this webinar, we will be sure to follow up over email and send the session recording. Thank you very much.
Hi, good afternoon, everybody. And to those of you on the West Coast, good morning. My name is Jim Hannon. I'm the practice leader of Withum's Manufacturing, Distribution, and Logistics Industry Group. So I'd like to thank everybody for taking the time out today for what I think will be a very informative conversation and presentation, and we're going to leave room for questions at the completion of Kevin's presentation. So with that said, Kevin Tynan is our guest panelist today and speaker. He is the Global Director of the Automotive Research Wing of Bloomberg Intelligence. So do me a favor, if any of you have Fox Business News or CNBC on, please turn it off, because Kevin will take a personal affront to that. But he's backed by popular demand. Kevin has been a good friend of our firm in providing some thought leadership and presentation to our clients, to our prospects, and friends of the firm. So we welcome Kevin back. As a little background, he has been the Director of Automotive Research for Bloomberg Intelligence since 2009. He is a proud graduate of St. Anselm College up in New Hampshire and a MBA degree recipient of St. John's over in Queens, New York. So Kevin, with cars being such a big fabric of our American economy here, we seem to be at a crossroads of combustion versus electric. And with the word electric vehicles, I'm going to turn it over to Jason Thomas, who is the practice leader of our electric vehicle practice out in the great state of Michigan. Take it away, Jason. Okay, Jason Thomas.
Is he on? It says offline.
Okay. I guess the internet is not running from Greater Detroit to New Jersey here. So we're going to pass the baton over to Kevin to get going on the presentation here.
Thank you, Jim. Okay, so just real quick. So just real quick, Bloomberg Intelligence is, for those who aren't familiar, is the basically investment banking type research arm of Bloomberg, which would include Bloomberg News and Bloomberg Television and Bloomberg Radio and the Bloomberg Terminal. And as Jim said, I've been heading up the automotive research for the firm since 2009. And before that, I came from the sell side, also covering the automotive space since the late 90s. So been through a lot, seen a lot of different things. Wanted to just talk about where we are in the industry and where we're going. The one thing is a lot of what we're seeing now, it's unprecedented in a lot of cases, and that's from the manufacturing process all the way through and out the retail channel. But a lot of these dynamics have been in place for years, even before the pandemic. The process from 2020 in March was accelerated some of these changes, but a lot of it was in place before. So let me start. This is usually the first slide I show in all my presentations, and you can see all the way out to the right there. That's our light vehicle mix in the U.S. And you can see the white line are light trucks, and that would include everything, minivans and crossovers and SUVs and pickup trucks. And you can see that through the period between the recessions of 01 and 09, there was a sort of back and forth between car and truck mix. And you can see where we've ended up now decidedly tilted towards trucks at 80%. So meaning 8 out of every 10 vehicles we sell in the U.S. is some form of truck. Now, I've said, and I've been saying this probably since about 2013, when is about the last time this was 50-50. This is 80% now. This goes to 85. This goes to 90. If you look at Ford, General Motors, and the Stellantis domestic brands, they're in the upper 90% truck mix. And where we get pushed up above 80 to 85 to 90% are as the import brands start to catch on, maybe not in the full-size pickup space, but in a lot of the crossover and SUV spaces. So one of the things we do at Bloomberg Intelligence is we like to get a little bit below the volume number and layer transaction prices above or on top of the volume. So you can kind of get a better idea of how a manufacturer, their brands, their nameplates, and the segments are ranked in terms of importance. So if you look at this one, and this is retail revenue, so this would be post-haggle transaction prices by the volume that we sell. That largest segment there, about $300 billion, is SUVs and compact crossovers or crossover vehicles. So those are combined there. But that pickup space is mostly all full-size pickups. So if you were to separate out the mid-size pickups, things like Toyota Tacoma and Chevy Colorado, from F-150, Silverado, Sierra, and things like that, the full-size pickup space is the largest in the U.S. by retail revenue, by a big margin, by about $30 billion. And why this is important is that this is orchestrated, right? And if you look to the left of the chart there, average transaction price of a large pickup is in the mid-$50,000 range. Compact SUVs are in the low $30,000. And this is something that has caused that shift to 80%, right? You have automakers going where the profitability is, where the margin and revenue contribution comes from, and that's in trucks, not just pickups, but also SUVs. Why this is important and electrification starts to play into this is that any emissions or fuel economy standards that need to be hit used to be done with small and mid-sized cars, which were largely unprofitable for the manufacturer. And we've seen over the years that those are exactly the vehicles that have been phased out. Chevrolet Cruze, the Fusion Focus from Ford, Stellantis brands only have one sedan platform left anymore, that LX platform, which is Charger, Challenger, and 300. No cars at all in any of those Dodge, Chrysler, Jeep, and Ram brands. So where EVs have played into this, it has enabled the automakers to back out of those car segments, because instead of selling 180,000 Chevrolet Cruze unprofitably to hit your corporate average fuel economy goal, you can sell 20,000 Chevrolet Bolt EVs unprofitably and hit the target, losing less money. So that's why we saw in the first quarter of 2022, our domestic manufacturers were up over 95% truck mix by unit volume in the U.S. So this is something that doesn't go back the other way. And again, simply because those other products don't exist anymore. There are no, from our domestic manufacturers, there are very few cars to even sell. And just here's a picture of what that retail margin by segment looks like. As a manufacturer, you want to live where those red and white lines are. And if you can trade the consumer from mid-size and compact car up to mid-size and full-size crossovers, SUVs, or pickup trucks, like I said, your revenue and contribution is much better. And let me make this point right here, because I think a lot of investors that I talk to and consumers that I talk to think that this market is driven by the pull of the consumer. And I've really been sort of pounding the table lately saying, like, look, this is the manufacturer and the retailer. Full-size pickup trucks are the largest segment, not by accident, right? It's where the automakers and the dealers want you to live because it's a $54,000 revenue contribution versus something considerably less for any other brands. Which, as we walk through this, you'll understand why I think a lot of these dynamics that are in place and moving into place now don't necessarily reverse when we get post-pandemic or when we get post-chip shortage. I think this supply-demand balance is going to keep pricing and that balance much, much tighter than we've ever seen before. I'll give you a little evidence of that in a little bit. So again, here, when you look at the full-size pickup space, here it is for our domestic manufacturers, and I include Stellantis in there because of the Dodge, Ram, and Jeep brands. But by retail revenue, that one segment is almost half of the revenue contribution. And when you look at it on a margin basis, it's probably upwards of 75–80% of the operating profit contribution for those manufacturers. So again, this is where we're being marketed these vehicles. This is where they want to be. This is where they want the volume to be. And just a quick view of it by segment. And again, this just speaks to the walk away from smaller vehicles and the impact they have on an automaker's bottom line versus what the large pickup segment can do. And that large pickup segment by volume, 200 can be about 3 million units and about 130 billion in 2022 when we look ahead. And at the bottom there in the amber lettering, you can see where an automaker would be in revenue contribution on a compact car or a mid-sized car, low 20s, and now our average is somewhere around $45,000. So these are below average revenue contributing and margin contributing vehicles, which is why the industry has really moved away from it. It's a business that our domestic manufacturers have really ceded to the import brands. And here's just a picture of talking about we're very, very early in the stage where electric vehicles make up a big portion of unit volume or revenue contribution. But again, where you see the mid-size and compact car volume decline, and you start to seeing those EVs pick up a little bit. It's still minuscule, maybe 2.5%, 3% of the market, but it enables manufacturers to do more with fewer units, right? Because you're doing 80% truck, and then you're hitting any regulatory emissions or fuel economy goals with much fewer electric vehicles than what you needed to do in a compact and mid-sized car. So let's talk about EV adoption a little bit. So here's a picture of what it looks like as a percent of total volume across the different regions. And Bloomberg Intelligence Auto Practices is global. There's a team in London, team in Tokyo, team in Hong Kong, and I'm heading up, the North America research as well and aggregating it all together. And so you can see, and I was actually just in Washington, D.C. at the Public Policy Day speaking at that event, and there was a lot of talk from senators and politicians in general about this push for EV and our leadership position in EV and how important this is going to be going forward. And you can see that really as a percent of volume, we're lagging in EV. The very clear, simple reason for that is that Europe has the government motivating emissions reductions after the diesel scandal. Asia countries, China specifically, is either penalizing manufacturers for not selling more, banning internal combustion vehicles in certain cities, and or subsidizing the consumer and the manufacturer to sell more of these units. So we're going to continue to lag, and this is what it looks like in Europe. And the important thing here is that as EV adoption outpaces the U.S. and Europe, this is not because it's a profitable business. It's because the regulatory requirements are forcing the manufacturers to get there. So Volkswagen really kicked off the diesel emissions cheating scandal. It obviously more than behooves them to make sure they're compliant going forward. And actually, we're seeing a lot of these EV sales coming at the end of the year where it's like, a basic Excel spreadsheet, like how many do we have to sell to be compliant? Let's just hit that number because the fines become prohibitive. Now here, if we look at it in the U.S., and the point I want to make here is that what we're doing in the U.S. is we're subsidizing the consumer with federal tax credits, which were $7,500 for the first 200,000 units sold. There's talk of increasing it to 10,000 or 12,500 for domestic brands with union labor. My argument is this doesn't get you adoption. This doesn't get you consumer adoption. And the example I'll give is if Jim Hannan here is a consumer with a $7,500 federal tax credit. Heck, let's double it. It's a $15,000 federal tax credit. Alexis over here is the government, and she's got billions of dollars. Let's call it trillions of dollars to invest in infrastructure. So there's a charge point on every corner, every backyard, every highway is lined with EV charging stations. But I'm the automaker, and I look at my P&L, and I'm losing $10,000 to $15,000 per EV. What happens? I don't build them.
Yeah.
So Jim can wave his money at me. Alexis can talk about the infrastructure she's building, but me as an automaker don't make a real effort on electrification yet, and that's why we're
not seeing a dime.
Right, and that's why we're 2.5–3% penetration here. Now, the government is either going to punish, like in Europe, or motivate or subsidize, like in China. But this idea of subsidizing, and it's really not even it's a tax credit, right? One time, no carry forward, and it's only equal to the amount of federal tax you have to pay. So it looks like it's one of those things, and my thing is like, well, why not give that money to the automaker to make them whole on that $10,000 or $15,000 loss, which would never happen. I know that would never happen, but it would make a more honest effort for automakers to get there. One place, I'll jump back to full-size pickup trucks, is where our domestic automakers, when threatened, have to defend. Right? We talked about this most important segment by far. Tesla makes Model S, Model X, Model 3, maybe BMW, Mercedes care about those vehicles. Tesla teases Cybertruck, a full-size pickup truck, and Ford, GM, and Stellantis' Ram brands aren't going to mess around in that space. That's the most important segment for them to protect, which is why now you're starting to see F-150 Lightning will be out in the first half of this year, Silverado EV starting to come. That's the segment that they can't mess around with, even if it means losing money. Point is that in the U.S., the way the government is addressing this comes down to profitability for the automakers. So when does EV reach a tipping point of penetration in the U.S.? The simple answer is when it's profitable, or when it makes sense for the automakers to defend that turf in full-size EVs, which is where they are. Okay.
No, we're good.
We're good? Okay.
Spot. Yes.
Okay, so now the point there, the tipping point of EV adoption, again, comes from the large automakers. We've seen Tesla really is the market in the U.S. at this point, and we're still 2.5%. And those are the pure play EV companies are those in red. So you can see Tesla far and away the largest by market cap, but it's really going to be Toyota, Volkswagen, General Motors of the world, BMW, where when they see profitability, at least in the U.S., when they see profitability in that technology is where we get adoption up to where Europe and China are. It's going to happen way more organically here with the way the government is approaching federal tax credits or infrastructure spending. So keeping in mind Tesla is the largest by market cap by a huge margin, there it is in terms of global unit volume. Really, if I were to include all the other automakers, it wouldn't even be on the slide. some of these companies. So again, this is where scale, and when I say scale for the Toyota, Volkswagen, General Motors of the world, we're talking about production, engineering, design, finance, distribution, after-sale scale is already in place for these manufacturers in basically all regions of the world. Now it just comes down to seeing a path to profitability in EV and developing the technology, or actually releasing the technology. They all have it when there is a path to profitability seen. And so here, just to emphasize the point of production scale, right, this is what it looks like just for North America out to 2025, right? So, Tesla in the U.S., and that's probably 750,000, and that would be with the Austin plant and the Fremont factory, still nowhere near the scale of other automakers, just in what they're producing in North America. So again, if EV is going to happen, it's going to happen because the scaled large global automakers want it to happen, not from the Rivians, Lucid, Teslas of the world.
Sounds like GM's in up to their neck, huh? Okay. All right. Thanks, Kevin. A lot of moving parts, so to speak, on both the combustion and the electrical vehicle. Now, I know you're going to speak about the changing world in the relationship with consumers and dealers. I'm going to turn the mic over to Stuart McCallum, who's the practice leader of our dealership services. Stuart?
Kevin, thanks for the presentation so far. We get questions all the time from our dealer clients, prospects, and just those in our networks about what the future looks like. With respect to discounts, incentives, will we get back to the inventory levels that we had before? And, I'll put you on a spot here and I guess ask a question for you that I think a lot of dealers have on their minds, but again, we all hang around other dealers, so we kind of are in an echo chamber. My question to you is, is it possible that any OEM, based upon their size, can really learn the lesson of discounts, incentives, overproduction of inventory, underproduction of inventory, or, is it possible that we've really turned the corner on this, or will the game of incentives at those corporate entities kind of push us back to where we were?
Yeah, well, I'll get to this in the final part of the presentation. Yeah, the short answer, Stuart, is yes. I think, this is a pricing dynamic that the industry has been pushing for decades. And I think that the changes we've seen, while we probably have swung the pendulum a little bit too far, and it stands to come back a little bit, but this period has been more effective in getting pricing and supply-demand balance, even more so than the bankruptcy period of 2008, 2009. And I think a lot of it sticks in my mind because this is what is good for the manufacturers and what is good for the retailers. So again, the influence of the factory producing or not overproducing, the influence of the factory not choking dealerships with inventory and then trying to figure out how to sell it, whether it's discounting or incentives from the manufacturer, we're out of that. We were a little too far past it maybe in some cases, but it's what the industry has wanted to do. So a big part of that is the cost rationalization that happened, and that happened in the bankruptcy period, but it's actually been more effective since the start of the pandemic. So what I've been saying is that this, right, so the example I give is that period from, say, 2001 to 2008 or 2008, we were a 17 million unit market on average in the U.S. GM and Chrysler went bankrupt. and Ford narrowly missed because they took down like $26 billion right before the credit markets froze. So it's not just a story of, oh, if we do 17 million units, that's the way the cost structure was aligned back in those days. You needed to keep production going. And I'm sure your dealers know this, but the UAW agreement at the time was idled workers got 95% of their money to sit in the jobs bank. So all that has sort of been rationalized to the level where this can be a healthy, profitable 15 million unit market. Which means that pricing has to adjust, that margins will adjust for it. But the days of overproducing and then figuring out how to sell it, most likely with discounts and incentives, I think the lesson learned here is learned, and that the rush to go back to that, you may have an import brand pushing for market share, a Nissan or a Hyundai Kia that may be a little bit more flexible on pricing than the others want to be. But those brands were already in the sort of sweet spot of inventory. So to give you an example, Asia-based manufacturers would typically keep, and dealers will know this, but you want to be somewhere between 55 and 65 days of supply. Those companies averaged in the high 50s, low 60s. Our domestic manufacturers averaged in the 80s. So the change is going to come from that, right? Ford has talked about an order bank. So instead of stocking units on the lot and and then having the consumer pick something that they really didn't want, color options, whatever, and then adjust the price to do that, I think goes away. And the other thing is that the consumer has been or is being conditioned by the new or the nascent EV manufacturers to pay sticker price, right? Tesla is direct sales. They don't have dealerships. So what do? You go online and you configure your vehicle exactly like you want it. You pay the sticker price, you get the vehicle. You have to pick it up at the mall, but you still get exactly what you want. And I think that lends itself to some stickiness in pricing for the consumer. And I tell people all the time, I hate going to the dealer. And I go, well, walk into the dealer, point at the window sticker and offer to pay that price, right? Your experience will be great. They'll sit you right down. You'll sign the papers. You'll get out of there. But everybody wants to go in and fight over pricing, and then say they hate the process. So I think that this move it doesn't become direct sales. That's not what I'm saying. But I think the process up through the retail channel is going to look more and more like direct sales, be a much smoother process. And I think you can get consumers to say, like, hey, if you're going to take the hassle out of the process, I'll pay you what you want. Let's do this deal. So kind of a long answer to that, but we'll talk about some of that in the second half of the presentation.
And I should say we have Tom DeFelice from Circle BMW here. So I don't want to hear anything about haggling price with dealers. Is that right, Tom?
That's right.
Okay,
That's right.
Good.
I'm right here.
All right.
All right. So let's talk about some of these, the retail landscape here. So we talked about inventory. We were looking at it at days supply, and this number is probably in days in the 20s now, right? 60 is about where you want to be, but this is unit volume. So you can look back in 2019 in the old days of 17 million units, and just for context, 17.5 in 2016 was the peak. That was the all-time record. This, in the US, we were running at 4 million units of inventory on the ground. We're now just peaking above 1 million units. So the idea is, if you want pricing and margin power, right, what's your rush to get back to 4 million units, right? We saw all the things that happen at 4 million units on the ground. Honestly, I think we're not 1 million units for the rest of 2022. And I say this, chip shortage or not, right? I'd be surprised we get anywhere near, we won't even get near 3 million units by the end of this year, I think. And again, that supports pricing. So here's average transaction price in the U.S., which is one of my favorite metrics. And you can see we're at an all-time record, $45,000 per unit. Now, some of this is that firmness of retail pricing, The other thing is that 80% truck mix, right? We went through that whole process of transitioning the consumer into the truck segments from the midsize and compact car segments, and this is what you get, an average transaction price that is just going to be inflated, but it is reflective of the 80% mix. Now, at 80% mix, if we're going to 85 and 90, maybe there's a little bit more upside to this. Maybe as electrification takes hold. I'm not sure that necessarily drives the price higher, but it will certainly support higher pricing. This is not something that I would see retreating, right? I don't think we're ever a 35,000 average transaction price market again, nor do I think we're necessarily 50 or 55, at least in before I retire, at least, which is all I really care about, Jim. But so you can see transaction price at record high. But here's where it starts to get interesting and a little dicey, is that we look at the average transaction price, but we look at it relative to the MSRP. So what we call is a typically equipped MSRP. You can see that, to me, and as any auto dealer or anybody who follows the auto industry, this is an amazing slide, right? This is transaction prices on average across the industry for 4 months in a row being above MSRP, right? I never thought I'd see that. That gap is 6.5% and I'll show that on this slide right here. So here's the average discount. And to put this into context for the consumer at the dealership, that average discount from that period 15 through 2019 was 6.5%. And again, transaction prices weren't always $45,000, but even if you take 6.5% off of a $40,000 vehicle, you're talking about $25,000. Which is to say that the average consumer could walk into the average dealership, look at the average window sticker and say, I want 6.5% off that price. And the dealer didn't even blink. That was just the cost of doing business in those days. As inventory came down and supply was constrained, chips or otherwise, this is where we are. We're actually, the month of January was an average of $434 over sticker. Now, and in the bottom in red there, I have, that's a $41 billion shift in retail revenue from the pocket of the consumer to the pocket of the dealership. So again, thinking about that, what's the motivation to go back to the old ways of doing things, right? To take $2,400 per vehicle out of your pocket to close a deal, or to have a reasonable supply and demand balance where I don't think we stay over sticker price for very long, but I think, again, with all these factors from supply-demand balance, the way the consumer is being conditioned to pay MSRP by new automakers, like, I think we're way closer. The other thing is, and I don't think I have a slide for it, but we also track average incentives. So this discount is from MSRP. We also track what the manufacturers give back in factory incentives. And that number has averaged 10% historically. In the period that this was 6.5, that was 10. So that means on a $45,000 vehicle, the automaker was putting basically $4,500 in cash on the hood to close the deal, in addition to the discount that you're seeing here. The incentive number now as a percent of transaction price is now below 5% industry-wide. So again, for the manufacturer, instead of $4,500 to close a deal, we're closer to $2,000. And again, if you, like I, believe that this is what drives the industry, automakers and dealers saying like, nope, we're good with this kind of balance. We are more than happy to do away with handing that money back to the consumer, because that's directly in cost of goods sold for the manufacturers right there. Call it $2,000 on 16 million units that stays on the manufacturer's P&L. So what's happened here, and this is like almost a whole nother webinar, but looking at the dealership retail gross margin by segment, and obviously this is for the publicly traded dealer groups as a whole, and the AutoNations, Penske's, Lithia, Group 1, those kind of companies. Interesting, retail gross margin on new vehicle is actually above used vehicle, first time in history also. So why this is important is that we started to see prior to the pandemic a shift of dealer groups really pushing into the used vehicle space, right? CarMax really kind of dominated that segment, still does in terms of unit volume. And then you started to see, well, if gross margin, and you can kind of see it there, where that white line bottoms out in 2019 was like about 4%. So think about that, 4% gross margin on your new vehicle. You're going to go look for other ways, whether that's the parts counter, service bay, used vehicles, finance and insurance, whatever you're going to do, 4% isn't really cutting it. So there was this big push to bulk up in terms of used vehicles. And that's where we see Carvana created, right? It's probably a dirty word on this webinar, but that's where that comes from. Carvana is not a pandemic or a COVID thing. That was in place before because of the opportunity in the used vehicle space, right? You're not fighting oversupply and discounts to move your new inventory. Your product can be differentiated on the used side. So an amazing statistic. I'm not, I'd be interested to see if this will stick, but it's an amazing thing to see new vehicle gross margin above used. Now, one of the things, because people will say, well, what about pricing? As new vehicle prices go to $45,000 and above, does that push the consumer into the used vehicle market? And the thing I say is it's not new or used vehicle price in a vacuum. There's what I call the affordability gap between the two. And then as that stays narrow, you'll get the consumer, some seeing the benefit of first owner, full warranty, any of the other ancillary products that you would get, subscription-based services that you get as the first owner. So where we saw $45,000 in that previous slide, here it is with used vehicle prices. So you can't just look at that $45,000 and say people are going to buy used, because this is what's happened with used vehicle average price. And I just did this for a client yesterday. Pre-pandemic, wholesale used vehicle price was somewhere in the $11,000 range. Now it's $17,000. So it's kept pace, more than kept pace. And here's what that looks like, the affordability gap. You can see there are some spikes in some periods, but for the most part, that stayed about the same. And again, that makes it a little bit easier for dealerships to maintain volume on the new vehicle side. In fact, anecdotally, we just did this. We were looking. I'm a big fan of depreciation, so I like used vehicles. But for my wife, we were looking at like a 1-year-old thing, but the price was just too close to MSRP on new, so we just bought a new one. So now here's where the used vehicle, there's concern that used vehicle prices come down. That pool is much bigger, right? About 40 million used vehicle transactions per year, including peer-to-peer. And people are saying like, oh, this price is going to collapse. It's going to come down. Here's one reason why I say that may not be true. So lease penetration in the U.S. has averaged, typically 30%, much lower now. So to put that in context, we look at lease penetration of 30% on 17 million units is 5 million units off lease every third year. So if you look at 2022, you would be looking at the lease penetration of 2019, which was a 17 million unit year at 30% lease penetration. So we're going to get 5 million off lease vehicles back into the market, which is a nice number, right? It's been above 5 million for the past couple of years. That's your CPO vehicles. Those are sort of the best of the pre-owned stuff. 2020, we did a 14.6 at a lease penetration in the high 28 or so. So it's somewhere around 4.3 million units coming back off lease in 2023. Problem is, in 2021, we were a 15 million unit market at about 20% lease penetration. So now we're talking about 3 million off lease. So we go from this supply of off lease vehicles of 5 million, and again, that's a portion of the used vehicle inventory, but it's an important one, goes from 5 million, which I think started in 2019, 20, 21, 22 are all 5 million, then we go 4, 3, then we go 3. Right, which will make it more difficult to acquire used vehicles, but it should also, just economics 101, support the pricing trend of higher used vehicle, which again, then that goes back to the affordability gap between new and used, and it's another reason that I think we can be really sticky on new vehicle prices near MSRP. And here's just the breakdown of that. You can see that period, 15 through 19, that was 17 million unit market that we're doing roughly 30% lease pen, and you get your 5 million, and then there's the drop in units in 20 and 21. And then here's your lease that you would layer on top of that. So, 21 was at 15, it was up from 2020, except that lease penetration dipped. And there you can see the number. I think, it gets right to about 3.5 million units in 2024. So again, another support for where I think pricing stays firm, along with the way the consumer is being conditioned to pay MSRP by new entrants in the space, where automakers are going to be more conservative with output and really try and maintain that supply-demand balance. I will leave it there. And if we have time for questions, I would love to discuss.
We have a few, Kevin, that have bubbled up, and we're honored to have the CEO of Wholesale Auto Supply Company here, Andrea Karsian. And, we're not just sitting in virtual. We're starting to come out a little. So we have some valued clients and contacts of the firm here in our office in East Brunswick. So, Andrea, I'll turn the mic over to you. I think you have one.
Thank you very much, Kevin. That was really insightful. I'm always fascinated by some of the numbers. So I've been in retail, now in distributor to automobile dealers. So my question would be, if you had to bet on which of the large automakers would win the EV volume, say by 2025, who do you think that might be?
Globally or in the U.S.?
Well, give us both.
Globally, I think Volkswagen wins it. Again, the motivation in Europe, you have government cities banning internal combustion, you have coming out of the diesel scandal, the sort of stigma of kicking that off. And that scale is already in place, right? That's an automaker. And I actually have this discussion with our London-based auto analyst, and he seems to think that Volkswagen passes Tesla next year. And we actually debate whether it's this year or next year. So that goes back to the idea of scale, right? And it just comes down to putting the drive. There's obviously materials and battery supply constraints that become an issue, right? Access to those kinds of things that you can get the lithium and you can get the cobalt to make the batteries. But assuming that's a level playing field, Volkswagen for me on the global scale. Domestically, I really think that the F-150 Lightning is a big deal for Ford, right? Mach-E is already in place. They say it's profitable at about $50,000. They're going to get F-150 Lightning to market first. Here's the thing about Ford and GM on full-size electric pickup trucks. So let's take Ford, for example. Ford will do about 800,000 F-Series per year. 20% of those are fleet, right? So there's 160,000 units per year that are to a customer base that is only going to buy Ford F-150. Which is why F-150 to me doesn't look like Cybertruck, right? Because you have people who have their businesses built on the specs and the utility of that vehicle that Ford has in hand already. So I think what you do is you start at that point securing your fleet buyers, and then as it sort of disperses out or bleeds out into your retail consumer, you'll get those people buying also. That's a little bit more difficult. The retail buyer, if people live in apartments or don't have access to charging or drive long distances and have certain needs. But I think the F-150 for me is interesting for Ford. Now, what I will say is, and this is something I'm starting to think about and write about, but General Motors talked about the GMC Hummer. They sold actually one in December, so they got one in before the year ended, and then they'll come with Silverado EV late this year into 2023. Is that they named Chevrolet Equinox as a compact crossover EV, and I actually, and I'm not making this up, but years ago said, you will know an automaker is serious about electrification when they're doing something that they can sell at volume, because it has to be profitable, right? My joke on, and I don't mean to joke on Chevrolet Bolt EV, is that, well, it looks funny. People compare it to Tesla. It's not as good looking. It's like, well, because they didn't accidentally want to sell too many.
Yeah.
Right?
Controlled it.
Right. In 2016, GM came out and said, we lose $9,000 per Bolt. So how many do you actually want to sell? And the answer is fewer than zero. So to me, and I was just looking at these numbers, the peak of Equinox was 346,000 units, right? So if you're unprofitable on a nameplate that can sell, you're in trouble. So I think it's a turn, and why I say it's important, but Ford can just as easily say like, well, okay, we're going to take the underpinnings of Mach-E and we're going to put that under Escape or whatever, and at that point you're building a skateboard with a different body, and that's when it'll happen. But again, profitability is without our government influencing one way or another, penalizing or subsidizing, it falls to the market to act like a market, and that's when it'll happen. So I do like Ford and GM's chances to be leaders here. I'm surprised by Toyota. I think Toyota has really lagged, especially if you think they were first to the market with Prius. But given they are Toyota, they will catch. I say all the time, Tesla sold 900,000 units 10 years in. Toyota wanted to do EV, it would do 1 million units in 6 quarters, not 10 years. But there has to be that motivation. And for me, here, this market is profitability and nothing else.
Okay, I think we have a question from Tom DeFelice, who's joining us here in East Brunswick. Tom.
Hi, representing the dealers out there. But one of the few worries dealers have on the heels of what you just said is the EV startups, because they've chosen a direct-to-consumer model so far, and they've been successful at carving out exceptions to franchise laws in the United States in order to do that. Tesla has obviously been successful. It looks like perhaps Rivian and Lucid are going to have some success on their heels. Do you see any additional startups having success breaking into the market, or do you think that competition from the legacy manufacturers is going to make it too difficult for new market entrants?
Yeah, and I think, for years I've been sort of dealing with this definition of success, right? And it really depends how you look at it. Tesla, I think you can call a success in terms of market cap. They were profitable really for the first time last year. 2020 was a profitable year, but federal regulatory credit sales were actually more than the earned profit. I still believe that you can't be a scaled volume manufacturer in the U.S. selling direct. Just no way. If you're Tesla and you're selling 300,000 units and people can pick them up at the mall and get them serviced by a flatbed coming to your house, like maybe that's on, and that business segment for them is unprofitable, right? So that's costing them money by not having franchise dealers with parts, with service bays. It's just, and I have to believe that they know if they were going to be a 2.5 million unit a year player in this market, you would have to have dealerships. You would have to. So the idea of Tesla being successful with direct sales at this point, okay, arguably true, but is it scalable, right? And that's the same thing with Rivian and Lucid and whoever else. I think it's a very, very different animal when you're selling 4 digits of vehicles per year versus 2 million. And just the after sales portion of it, another anecdote, there's a handful of people in the Princeton office and we just overheard somebody saying yesterday that it's their first day back in the office and they had to get a ride from the husband and the guy said, car's in the shop. He said, don't you have a Tesla? He said, yeah, it's been in there for a month and a half.
No parts.
Yeah, no parts. So that, if you're going to sell 1 million a year in the U.S. and then you're going to have a registered base car park, right? So it's not just selling the 1 million a year, it's the existing registered ones, right? So now you have 10 million vehicles in your fleet in the consumer's hands. You just can't go pick them up and you can't flap it, and to make this point, everybody talks about, or investors talk to me about all the time about over-the-air updates, right? How great that is. And it's, they just send the update to my driveway. And I'm saying, yeah, because they don't have dealerships. So if I'm General Motors, right, who am I screwing by sending over-the-air updates? You, right? And going back, you were only making 4% gross margin on new vehicles. I got to throw you some bone, right? So get your people to the service bay where it's 50% gross margin, 60% gross margin for most of the dealer groups. So, people don't understand that's better. And it's yeah, well, it's that way for a reason because they have no other way of doing it, right? If they have a recall, what are they doing? Sending guys in overalls to your house to fix the car in the driveway. It's just not scalable. So I'm not a big believer in the direct sales model, and not because I think it'll get fought in the courts. I think it's just not a manageable, scalable business model.
Great. We have a question from one of our folks. Sounds like they're from one of the flyover states. Charging stations. Will deployment meet demand for EVs? And how likely are consumers ready to spend for upgrading chargers?
Yeah,
Do you have a couple hours for this one?
Yeah, I mean, infrastructure for me is a funny thing. I believe on the one hand that it will get marketed right out. So the idea is that, and back to my earlier example about you can put charging points on every corner. When it's profitable, we'll do it. People will charge at home. Will they upgrade? Will that be subsidized? There's sort of all these questions. I think infrastructure or charging infrastructure for me comes down to, again, if automakers are profitable on EVs and they want to sell them, I think there's a little bit of maybe science that we get better range. But I think at the end of the day, just like we are buying more full-size pickup trucks for suburban dads than ever before, I think range anxiety gets marketed right out of existence.
Okay.
Right? So that right now, if I don't want to sell EVs, I make up range anxiety.
Yeah.
Right? So it only goes 300 miles on a charge. And what are you going to do? Right? You can't drive it from here to Detroit. But I think once that there's profitability and those vehicles want to be sold, it'll be like, well, you'll charge at home and then we'll have these things on the highway and you'll get 80% of your range in 20 minutes, which is what it takes you to buy a hamburger or hit the men's room. And there you go. And you see, no more range anxiety. There we go. I fixed it.
It's just different. It's just different.
Right. I think how it gets talked about is going to be different. It's not to say the government isn't going to invest. I was just reading about, lining the highways with charging stations and, so it'll come from both sides. I don't think it's a driver one way or another. Again, I think the driver is in the hands of the manufacturer. And when the manufacturer looks at his P&L, says, I have to do this, then it'll happen. And then infrastructure and all those other things kind of take care of themselves.
Okay, another one from the audience. Tuesday's Wall Street Journal had a less than complimentary article on green vehicle pre-revenue startups. What's the biggest risk you see on this one?
Well, other than the obvious answer, let me answer it this way. I believe that Rivian, Lucid, and anybody else who comes along publicly traded in this space does not get the, I don't know what you would call, I don't want to call it a free pass, but you will not get the consideration that Tesla got. There's going to be a lot more due diligence. There's going to be a lot more scrutiny on all parts of that business that Tesla did not get, because they were the first mover. They were, so, there was a time, I think it's down considerably from that, NIO, Chinese EV manufacturer, was a $100 billion market cap company. And I would ask, like, oh, it's bigger than GM. It's bigger than GM and Ford combined. And I go, how many units did they sell last year? You know what the answer was? 43,000, right? So to put that in context, Ford will sell 75, 80,000 F-150s in a month in just the U.S. So this is a company that did 43,000 units globally in a year, and it's worth more than Ford and GM combined. So I don't think that kind of craziness happens from this point forward. And a lot of those things that Tesla was able to do, being unprofitable, selling fewer than 1 million units globally, yet you're worth $1 trillion. So I think we've seen the last of that, at least in my mind.
Okay, interesting. Lou Young.
Thanks, Jim. We had a big announcement yesterday in New Jersey. Trenton is going with autonomous vehicles for public transportation. I don't know that you mentioned autonomous, but you want to give us 30 seconds on where that's headed?
Yeah.
Literally where it's headed.
Yeah.
I guess that's the issue, right, Lou? Sorry, Kevin.
I'm not sold on full level 5, no steering wheel, no pedals for consumer, for passenger vehicle yet. I think fixed route, geo-fenced buses, campus, the route is mapped. It's, I think all that's possible. And I see a lot of, like I said, I was just out at CES. I mean, there's 800 LiDAR companies if there's one. And it seems to me that where we're at is being able, with hardware, to bring data on board a vehicle. I think the difficult part is the last 10% where we're interpreting and implementing what to do with that data. So, and I've driven them all, right? I've driven Autopilot and Super Cruise, GM, and they're great systems. I still don't trust them. I think for what they're used correctly, they're fine. GM Super Cruise, right? Sunny day, mapped highway, 72 miles an hour, middle lane, great. And I'm thinking like, yeah, I could do that too, right? Like, so the idea that all conditions, all parts of the country, all times of day, that this is a better driver than the human being, I'm still not completely sold that that's the case. And we've seen that, right? We've seen accidents and, so the idea that it eliminates highway deaths is, I think we're a long ways away from getting there. But I do think mass transit, again, geofence, fixed route, those things, hey, go there, don't hit that, go there, don't hit that, at 20 miles an hour around the city is probably fine. And that'll happen first.
Okay, here's another one, Kev. Is current used car pricing elevated because of limited new car inventory? And if so, will used car prices come down as incentives increase, despite your prediction that the new car pricing will stay at current levels?
Yeah. I mean, and all that's related. So yes, I mean, used vehicle prices are inflated because of supply of new vehicles. Again, I'm not sure that's always going to be related. But I think what you're getting on used vehicle prices is a lot more dealerships trying to get those vehicles.
Okay.
You know, and off lease is going to be a part of that. Andrew, you're just saying you bought your vehicle off lease, right?
I did.
Right. So I think we're starting to see more of that where the captives are starting to funnel vehicles back to their brand, at least, if not the dealership who originated the lease, more frequently, and it's keeping more vehicles out of the pool. So what we're seeing is Carvana, Vroom, CarMax, and you're seeing this more and more, even on the classifieds, and I hate to call them classifieds, but like something like Cars.com or AutoTrader, like, hey, get an instant price, buy your car, right? You don't even have to buy something to be able to sell something back. So all the big used vehicle dealers are scrounging for inventory because, yes, there is fewer off lease or off leases coming in a different route or staying with the dealerships because that's what you can CPO and that's where the margin is. But, you know, again, there's a lot of that addressable market of used vehicle is huge, right? We do 40 million units a year. So there's used vehicles out there. So the influence of this current environment being that great on the market for the long term, I think is not realistic. I think it comes back down. But I do think we may see for the first time a little bit more disconnect on what the used market dynamics are relative to the new market, because I think the new vehicle market, like I said, the manufacturers are going to not overproduce on purpose, not discounting, right? So that depreciation of used vehicles isn't going to be as great. So I think there is some stickiness for those reasons on the used vehicle market.
Yeah, the same can be said for wages too.
Yeah.
You don't expect wages to go down from the bumps that people have gotten.
Right.
So, okay, I think we have time for one or two more, Kevin. Supply chain is a dirty word these days, but as we transition to EVs, where are the weak links in the supply chains?
Yeah, you know, this is the way I look at the supply chain, and you know, and this is sort of with my stock picker hat on without naming names. There's really three buckets, right? You're going to have the suppliers, and the purest play supplier on EV is going to be a battery maker, right? That's what that component is for. You're going to have a bucket of suppliers that are trying to transition from internal combustion to battery or to stay relevant with what they do as that, you know, and the most difficult of those transitions will be somebody who's making, you know, axles and, you know, hard engine blocks and things like that. And then you're going to have a bucket that is what I call technology agnostic, right? And that's going to be your tires, right? It doesn't matter what the drivetrain is. You need glass and tires and seats and, you know, electrical components and things like that. So, you know, what I'm telling right now is that materials are expensive, you know, and that's going to be, you know, just inflation. So that's going to be a choke point. It's obviously cyclical, maybe a little more so now than usual. But I think as an investor, you really have to look at where you want to be. Are you on the sideline saying, like, I'm not sure how fast this EV adoption happens. Maybe it doesn't happen at all. Maybe it just stays a niche product, right? Like minivans don't work for everybody. Sports cars don't work for everybody. Maybe electrification doesn't work for everybody. And it winds up being a segment of the market, you know, and then you want to be in a technology agnostic kind of bucket of suppliers that says, well, it doesn't matter if it's adopted or not. I'm going to stay with my, you know, Goodyear Pirellis of Michelin's of the world and say, like, well, everything's going to need 4 tires no matter what the drivetrain is. So yeah, the supply chain's is a mess. But what I've been cautioning people is that don't expect, for all the reasons we talked about today, that like, oh, there's chips, it's 2019 again.
Okay. Yeah.
Right? Like, oh, here's 17 million units, here's overproduction, like I think we're going to be much more conservative with output, regardless of where the condition of the supply chain when it eventually works itself out.
Okay. And finally, Allie, nothing else popping up. Here's our last question from the audience. Are any of the big players able to pivot production while meeting demand for both custom combustibles and EVs at the same time? They're separate plants or different lines, or are they all under one roof, I guess is the rest of the question.
Well, idle capacity is being converted. So General Motors, it's, Hamtramck plant is going to be EV. Spring Hill, which used to be the old Saturn plant. So you're sort of, as again, that compact and mid-sized car production is killed off, then you're going to sort of backfill those factories and retool for electrification. The new greenfield stuff will be the battery plants. But what I've been telling people and dealers especially is that, Tesla's been selling Model S since 2013, right? Like none of this is sneaking up on anybody, right? None of it's happening overnight. Like, so you'll see the progression, like I talked about, profitability. You'll see the nameplates they're talking about and say, well, they can actually sell that. That must mean we're at this point in the process. So same thing for the automakers, right? It's not like close the plant, make it an EV plant tomorrow, right? We're gonna fund the EV transition with all these full-size pickup trucks. I mean, when you look at just the fourth quarter earnings of GM and Ford, it was, phenomenal quarters. And phenomenal years. So that's really funding the transition, which again is not going to sneak up on anybody, and enable them to sort of pace. And again, everything I've talked about today, not only pace what happens in the market, but I think drive what happens in the market. This isn't General Motors going like, whoa, we got to catch up. It's like, no, we're going to set the market. We're with GM and Ford and everybody else that's going to start to push into EV, it's going to be at the pace that they want it. The slide was in there, I kind of jumped over it, but that federal tax credits, when I was talking about the ineffectiveness of federal tax credits, is like, but you have almost every do have every automaker except for Tesla and General Motors still have federal tax credit eligible from the first round.
Oh.
Right, and
outside of the infrastructure.
Right,
okay.
Right, from the old ones. And now, and even General Motors, which was over the 200,000 units, something like 75% of those were for Chevrolet Volt, which was the plug-in hybrid. It wasn't even for the full EV. Mm-hmm. So if you backed out Chevrolet Volt, they wouldn't be at 200,000 units on their EVs all these years later. So, it'll happen at the pace that they force it to happen. And that we may be closer to that tipping point, but ultimately it's not going to surprise anybody.
Okay. All right. Not seeing any more questions from the audience. I think it's a wrap here from Withum's East Brunswick. If you are on the New Jersey Turnpike at exit 9, please do not stare at our marquee on the top floor. That could cause an insurance issue. But Kevin, once again, thank you so much for your presentation today. And we thank you for trying to, look at it from a lens of what's going on in the market. 2 of my 3 kids are daughters. I'm happy I don't have to go to car dealerships with them, Tom, and haggle on price. It's just going to be, it is what it is. And we have clients, so we can't offend any clients. But thank you so much once again for supporting the firm. Comments. I think we are done. I will say I understand we have a big game coming up this weekend. So whether you're a Bengals, Rams, or guacamole or wings fan, enjoy the game. So, the presentation will certainly be available on our website over the next day or so. And I think we recorded this, right, Alexis, for for purposes of sharing it with some of your colleagues in the audience who couldn't join us today. So Kevin, thanks so much again. Nice job.
My pleasure.